Hey everyone, Rob B here with Rob D. This might be the most requested episode that we've had over the last few years. So many people want to know what is going to happen with the 18-year property cycle and what is going to happen with the property market. So in this episode, not only do we share our views on that and tell you what we think is going to happen, give you the date that we think the market is going to crash, but more importantly, give you the template of how we are going to invest over the next few years. So if you want, you can follow along and match our strategy. This is going to be an awesome episode.
Welcome to the Property Podcast. Thank you so much for joining us. This is a show where we take time out from advising a multi-million-pound property fund. You can find out more about that at portfolio.co.uk and share some of our knowledge with you for free. And thinking about what's going to happen next with property prices and where things are going is, of course, a big part of our jobs. But it's also, sad to say, a bit of a hobby and a passion as well. We love talking about this subject, and we know from the feedback that we get that you love hearing about it as well. So if you want to know how we feel about the market today and what we're going to be doing in years to come, then don't go anywhere. Let's get into our news story this week. And this actually is a warning from the boss of the NRLA about rent to rent. And he was speaking at the Property Investor Show and said, whenever there's a big problem, it normally links back to rent done badly. In other words, people coming straight off courses, telling them how brilliant rent to rent is and how easy it is, then landlords unwittingly handing over their properties to them. And those properties, surprisingly, not being brilliantly managed. And it also mentions the story, a high-profile rent-to-renter hailed as a success story who put his company into liquidation recently, owing creditors £1.5 million. Rob, this isn't something that's new by any means. Rent-to-rent as a trend has been around for quite a long time now. I'd say probably like a good 6 years or so. But it seems like the marketing around training people to do rent-to-rent, which is where the real money is picking up pace recently.
It is. And you know what? It's no surprise that the standards are so poor when the people entering the market are going via the channels that they are. And what I mean by that is people are sold the get-rich-quick dream through different mediums, often social media now. That seems to be the big one. And people are promised that, put this little amount in, this short amount of time later, you'll have this big number. If people can't be bothered to put the work in and are looking for wealth shortcuts, which, to be honest, doesn't exist. There are no wealth shortcuts. But if you believe that to be true, and you actually believe that you don't need to work hard, then when you finally manage to get a property, if you get that far, are you going to be a top-level landlord, attentive to all your tenants' needs, be there day and night, ready for any requests or problems that occur? Probably not, because you couldn't be bothered putting the work in to get into the place anyway. Why are you suddenly going to change and then become someone who grafts and does put the work in? But rent-to-rent does require graft. The thing on social media is it really, you just need a cynical, I was going to say bone in your body, but just fingernail to look at what's being marketed and go, wait a minute, maybe I should question that. We've looked at one this morning and we won't name the handle, but it's on Instagram and this person's got nearly 500 likes. And for Instagram, that's a lot of engagement. And this person's standing outside of a ropey-looking property. There's a wheelie bin on the floor. It's not anywhere I'd want to be moving to anytime soon. And just pointing in the air at big numbers and then walking off and saying, message me if you want to get into rent-to-rent and earn this type of money. All you need to do is look at it and go, wait a minute, this guy is trudging around what looks like a bit of a dump on a rainy day, walking around glum-looking streets, pointing at a building and pointing to the sky at big numbers that pop up on screen. And this is the person that you want to follow. Listen, if it was that easy, why are they walking around in abysmal weather, in not-so-nice-looking areas, trying to tell you that they've got all the secrets to quick money? If they've got the secrets to quick money, they'd just be doing it. They wouldn't be wasting the time making a proud of themselves on the social media, pointing at bits and pieces. Come on, people. I know people listening to the Property Podcast, 99% of you will also just be as cynical and laugh at these people as well. But I know there's also probably a few dreamers in our audience who want this to be true and are probably tempted to message some of these people. So this warning is for you. Don't buy into it. It's not real. Can you make money through rent-to-rent? Yes. Are there some people who do rent-to-rent really well? Yes. Are they in the absolute minority? Yes.
Yeah, definitely. And there's a warning on the other side as well, which is if you put a property up to rent and you do it yourself through one of these services that lets you list it on Rightmove or whatever, you will get lots of inquiries through from people offering you guaranteed rent. Be super duper ultra careful with those, because chances are they are one of the people who Rob's just talked about, who's just watched a TikTok video and decided to try it out. So you probably don't want your property in their hands. So while guaranteed rent for no work sounds almost as good as the untold riches you can apparently make from being a rent-to-rent operator, be really, really careful.
Before we get into this very exciting episode, and I know there's lots of people who are going to absolutely love this week's podcast, we know lots of you are loving that we're crowdfunding and that you can invest in Portfolio and Property Hub. Become a shareholder alongside Rob and I. You can do that. Last week's episode gives you all the information, but right now, as this episode goes live, it's pre-reg time. So you can register your interest. You can't become a shareholder yet, but because you're a podcast listener, we're giving you access to this link first, which means that you will be notified before the general public about the opportunity to become a shareholder in Portfolio and Property Hub, the whole group. We went into loads of detail last week and we're really excited about you, our community, coming along on this journey with us. So if you want to get more information and pre-register, then go to propertyhub.net/crowdfund. That's propertyhub.net/crowdfund. Enter your details, and then you will be informed when it goes live. And when it does go live, it is limited to how much investment we're going to take in, because obviously we don't want to give the whole business away. So by entering your details into this link, you'll be notified first and give yourself the best opportunity and grabbing yourself a piece of the pie.
Wouldn't it be amazing if you knew what property prices were going to do next? If you knew what the future held, you could time your purchases. You could maybe even time your sales. And you've got so much focus and confidence in what's coming, you can just filter out all the noise and opinion around you. Well, the closest that we've ever found to that as a guide is the 18-year property cycle. It's a concept that we first talked about all the way back in 2014. And as we covered on an episode recently, it's served us well since then. If you'd followed what the model had told you to do over the last 8 years, you would have done very well for yourself. But now we're further on in that cycle. Property has everyone's interest right now, and everyone wants to know what's coming next. There's, again, lots of noise, lots of opinion out there. So we thought, Rob, it was high time for an episode really focusing in on how to make use of the cycle over the years to come.
Yeah, I'm really excited about this episode because Rob and I sat down a week ago to really go through this in detail and share our thoughts and opinions on this. And I feel because of that, while both independently we had a good feel of where the market is right now and where it's going, we were able to have a chat that really helped us solidify our thoughts, opinions on what the market is doing. But more importantly, what we're going to do, how we're going to make investment decisions over the next few years and beyond. So we're going to share that with you today. We want to take you through what we think is going to happen, and then, because of that, how we will invest. And if you want to replicate that yourself, because we've had a decent track record since we started in terms of picking areas and where to invest, then great, follow along. Or just listen for entertainment and decide which bits you want to follow and which bits you want to ignore. But before we get into any of that, there's a chance that there are some people listening today who don't even know what the 18-year property cycle is and how it works. So let's give you a quick recap of what is the 18-year property cycle from a high level, and also where you can go if you want to find out more information.
Yeah, if this is a new concept to you, then go check out Property Hub University. We've got a course on this subject. It's really visual. It's the easiest way of understanding it. So just go to propertyhub.net/university, completely free. We've also recorded a few podcasts on this over the years if you want to go and do a search. But I'll give you a minute on the cycle now so you can keep listening to the rest of this episode without having to rush away and do that. So the whole concept of the 18-year cycle is, first of all, that property prices are cyclical. They will boom and then crash in a predictable way. And it'll happen over a cycle, which is on average 18 years long. And this has been shown to go back for about 200 years. You can go all the way back in the data. This cycle just keeps on repeating. And within those 18 years, it's predictable as well. things play out in a set pattern that I'll talk you through now. So first of all, there is a crash. And for the first 4 years, there's a process of that crash playing out, prices finding the bottom, people not quite sure how far they're going to go, but the bottom is found, and then prices stay there because everyone's too scared to get back into the market. So prices remain low and no one's interested in property. Then we get into the next 14 years of the cycle, all of which is growth, and that's split into 2 different phases of 7 years. So first of all, you have 7 years of property prices growing very slowly, gradually, gently, as people regain their confidence from the crash that's just happened. At the end of that 7 years, you then get 7 years of more aggressive growth. At the start of that period is something known as the mid-cycle wobble, where prices either stop growing or fall a little bit, but then the more rapid growth begins and lenders start getting more confident and really putting some fire back into the market. As you get towards the end of that 7-year period, that's when you get the real mania. That's when you get what you should truly call the boom, or what Fred Harrison, who discovered this, called the winner's curse. The last 2 years of the cycle are when you're in real speculative phase. Everyone is so confident and is getting so carried away that anyone will pay anything for any property and will be completely unconcerned about what it's fundamentally worth or what it's been worth in the past. They're just willing to pay more because they believe that property prices are just going to keep going up and up and up. But of course, that's not what happens. Just when everyone thinks that things are completely different now and prices will keep going up forever and everyone's going to be fabulously wealthy, that is when you get the crash. Everything stops, lenders get spooked, values fall, no one's interested in property anymore, and the whole cycle starts again.
So that gives you an overview, and if you didn't quite take all that in, remember, go to Property Hub University or our YouTube channel, Property Hub UK, search for the 18-year property cycle. Both are completely free resources that will go into more detail to explain what the cycle is. But let's just all assume now you've either gone off to listen to that, you've come back, you know what the cycle is and what it's about, or you already did. Where are we now? And this, Rob, is where it starts to get interesting, because the cycle has roughly followed previous cycles. But I think it's fair to say, and I don't think too many people would debate this, certainly those, who follow the 18-year property cycle, that the mid-cycle wobble lasted longer than normal cycles. It was almost that wobble area where there was little to no growth over a number of years. Normally it lasts 1 or 2 years, the mid-cycle wobble, but it lasted arguably double that, 4 years. Depends on what range you use and when you start to look at it. But the point is, the mid-cycle wobble has gone on longer. And there's a number of reasons why you could say that's happened. People will point to Brexit. And yes, there was uncertainty around that time. Now, does that change things? Because if you treat the 18-year property cycle as an exact template for what's going to happen in the future, then depending on when you start your count, you would say that the market will crash in 25 or 26. Interestingly, Fred Harrison says 2026, and we believe that it will be 2026 at the earliest, and possibly further out. We've said multiple times on the podcast that it's not an exact science, it's not an exact template, and sometimes you have runs that are shorter than the 18 years, and sometimes you have runs that are longer. But besides the mid-cycle wobble taking longer, we've only just started to see a growth phase. Last year, we had double-digit growth. And Rob, you normally will see more than a year or two of the boom phase. In fact, you'll see a lot of years, and we've only just started.
We have only just started, but because the growth that we saw last year in particular was so extreme, and in particular was so extreme when compared to people's assumptions about what would happen, which actually that property prices would fall, people may believe that actually we're in the real end game here. It's easy to think that we must be in this winner's curse phase, the final 2 years of the cycle, because property prices grew so fast last year. People will have personal experiences of the market being very strong / bubbly. People will be trying to buy homes and getting outbid. And particularly because there's a whole narrative about how high property prices are, I think it's easy to think, well, this is it. Property prices can't go up too much further. They're already too high. So clearly, if we're seeing growth like this now, this must be it. Within the next couple of years, it all comes crashing down. The cycle says that that shouldn't happen yet, Fred Harrison, who discovered the cycle and is looking at the data now as well, also believes not yet. He's saying 2026. But also, Rob, you've done a bit of a dive into the data from the last cycle. And actually, when you look at that, it suggests that we may not be in this end stage yet either.
That's right. And what's really interesting is that we have short memories. There's actually something called the economic memory, and people don't remember what happened last time. So we all, most of us at least, will remember that there was a property boom in the 2000s. But do you remember to what extent? Probably not. And you know what? Even we had forgot. We couldn't recite off year by year what the data showed. We could tell you across the board, but we couldn't go year by year. We can't remember everything. But like you would expect us to do, we do our research and we do look at these things. And what's really interesting is if you try to pattern match against the last boom, then actually last year closely matched the year 2000 in the last boom. Now, why do I say that? Well, last year was the first year we saw double-digit growth. In the last run, the first year of double-digit growth in the lead up to the 2008 crash was in the year 2000. Yes, that's how early it started. And that's how long the bull run went on for until the crash in 2008. 2001, which is closely matching to what's happening now, was again a double-digit growth, low double digits, like we have now. What's crazy, and I'd forgotten this, Rob, and I've gone to the ONS data and the nationwide data just to make sure what I was reading was correct. I wanted to really make sure that I hadn't read this wrong, but it's true. In 2002, the market grew by over and well over 20%. Depending on what data set you use, one of them shows at 25%, but between 20 and 25% in the year 2002. So we've had 1 year of double-digit growth, and people are like, well, this can't last. Well, imagine, I'm sure there were people in 2000 who were saying that. They had double-digit growth. 2001, double-digit growth. 2002, double-digit, but over 20%. 2003, double-digit growth. 2004, double-digit growth. And this isn't exclusive to the last market cycle either. A very similar pattern played out in the cycle before. So right now, because living in the here and the now is the most intense part you'll ever live. The most intense part is the present, right? The past is fading. The future you can't see yet, but the right now is always the most intense part of your life. So looking at the data feels very intense because last year we saw double-digit growth, and this year it's on course to get close to it. This is start of the growth phase, the more aggressive growth phase of the cycle. But if you think this is the top and you pull out investing now, well, based on the 18-year property cycle, you're going to lose a lot of money.
So I think basically what we're trying to address here is what a lot of people have been saying, which is like, are we in the winner's curse now? Is the market going to crash in the next couple of years? And our belief is no. And for me, at least, there are a few reasons for that. The first reason is the data that Rob just went through. It's clearly not anomalous to have a year, even multiple years of double-digit growth in that 7-year aggressive growth phase of the cycle, but not within the last 2 years. So if prices did continue strongly this year, then fall back a little bit for a couple of years, still grow strongly, but not quite as extreme, that would not be abnormal. But there are another couple of reasons as well. One is that lending is still relatively restrained, and lending is a huge part of the cycle. If you didn't have banks lending against property, or more accurately land, and changing their appetite for doing that and their criteria for doing that at different times, you wouldn't see such a pronounced cycle of booms and busts. But at the moment, lending is still pretty restrained. Various measures were put in place after the last crash to try to prevent some of the mad stuff that happened from happening again, and all those are still in place. So even though borrowing is still relatively cheap, there are various affordability tests and stress tests in there that mean you can't go and get an outrageous amount of borrowing. Also, criteria are still pretty strict. It's certainly not the case that anyone can just walk in off the street and get a mortgage for anything, which is what happened last time. It didn't matter what your credit score was, didn't matter if the lender had never seen the property. You could still go and get a loan at a super high loan to value. That is a very long way from happening at the moment. As the cycle progresses and people get greedy and banks get greedy, I strongly suspect that that is going to change, but we're not there yet. The other reason for me, Rob, is that sentiment isn't there at the moment. Yes, people are talking about property prices growing and people are complaining about being outbid on homes that they're trying to buy. But it's all with a general attitude of, this is mad. Why is this happening now? Is this a good idea? Maybe I should sit out for a bit. Whereas really, when you're in bubble mode, people should be seeing the exact same thing happening around them, but thinking the opposite. So they'll get outbid and see prices going up. And that's just going to make them want to pay more because they believe it's going to keep on happening. And at the moment, that's not the case. It feels weird to think that people can see exactly the same thing happening around them and come to two completely different conclusions about what that means and what they then do as a result. But it's true. But at the moment, the general sentiment is telling me that we're not in that bubble stage yet.
Exactly. You're right. And it's because this is a new norm. We've only just started with double-digit growth. What will happen is, after a number of years of double-digit growth, more people will accept that to be the norm. And they will believe that this is what property does. And property goes up in value at a rapid rate, and you can make lots of money from property and property investment. It's when your hairdresser starts giving you property investment advice and tells you about their flips that they've just started to do in about 4 years' time, then that's when you might want to feel a little nervous. And it's nothing against hairdressers. I'm sure there's some very switched on investment hairdressers, but I certainly know mine doesn't invest. But I have had crypto advice from a hairdresser previously, just before it collapsed. So be wary when the majority of the people around you start to show interest in property, not as a place to live, but as an investment tool. Because right now, let's face it, when you start to talk about property investment, people will tell you to bore off. Most people in your network aren't interested. Yes, you will have some people who are interested, but the majority won't be. And that's just the reality. But there will come a point in time where the majority will be. And that's when you know you're getting closer to the peak. When the majority of people start to believe that property is a tool, is an investment vehicle, not just to make money, but make money in a short period of time. Something we've said over and over again is property is a long-term investment. In a few years' time, people won't see it that way. So that gives you an idea of where we're at. If you follow the 80s, 18-year property cycle and the length of time that took to boom, then it'd be around 2026 for the market to reach peak before crashing. If you look at the 2000s boom, that would take us to 2029. So if you follow the 18-year property cycle, you look at what's out there, you would say that somewhere between 2026 and 2029, the market will crash. Now, we're on record. We've been on record since 2014, giving predictions. We've done all right so far. And actually, that's not a bad size window to give, somewhere between 2026 and 2029. But that's then. Let's face it, the reason a lot of you are listening to this right now is you want to know what to do now. So let's give you that template. Let's run you through how and where you should invest over the coming years. I'm going to break it down into years because your strategy should change as the market develops. But Rob, what should people do now? Where should people invest in 2022, 2023 and 2024? And the reason why we picked those years is that we believe the same strategy should apply for all three of those years. So what is the strategy? Where should people invest and what should their attitude be?
This is going to sound weirdly non-specific, but the answer for me is just keep buying and buy pretty much anywhere. The reason I say that is that where you buy and what you buy becomes far more important as time goes on, and we'll come to that soon. But for the next couple of years, a rising tide should lift all ships. And we don't believe we're at the time in the cycle where you need to be particularly nervous about what's just around the corner. So the main thing to do is to keep on buying and not get scared out of the market, as Rob alluded to earlier. Of course, we've got our favourite areas. We've shared our hotspots for this year back at the start of the year. We did an episode on that. If you go to our YouTube channel, Property Hub UK, you can find that video as well to see the areas that we're particularly targeting for our fund and for our investors and personally as well. But in the kind of market that we're expecting, it's hard to go too wrong. If you need a bit more of a confidence boost to do that, if you're thinking, well, actually, look, prices are still going a bit crazy and maybe I will just sit out until the end of this cycle. Keep in mind that in the last cycle, when prices crashed, they crashed back down to where they'd been just 2 years previously. So property prices fell on average, and averages can concede a lot, but on average in the UK by 15%, and the growth in the 2 years previous to that had been about 15%. So if you really believe that the cycle has only got a couple of years left to go, if that, then maybe you don't want to be buying. But if you're buying into our thesis that we're looking at longer than that, then actually, even if you buy now and hold it all the way up to the next crash and through the next crash, you should still end up with those prices bottoming higher than they are now.
And that's exactly what we'll be doing. In 2022, 23 and 24, we'll be investing as much as we can in our preferred areas, which Rob said you can find out where they are through the episodes that we put out previously. And yes, we may adapt those areas slightly year by year, but really, this is a time when you buy something, if you follow the cycle and you believe in it, you're going to see strong growth and be rewarded relatively quickly. Now, I repeat, you should view this as a long-term investment because property absolutely is, but there is a window that's just begun where you're going to feel very smug about your investments because if you buy into the 18 property cycle, you believe that they're going to move up significantly over the coming years. So that's a really easy path to follow for the next few years. But what do you do and what will we do in 2025 and 2026? Well, I'll tell you what we'll do in a minute, but a strategy you could deploy if you're interested is trading in and out. Now, this is not for the faint-hearted, but for those who are braver, have a higher appetite for risk, then you may consider this strategy. And this strategy is going into areas that are generally classed as not as desirable, not that desirable generally, but they'll do well. And the reason why is if you look back at previous cycles, areas of the country that have kind of been left well alone, people haven't really touched, property prices haven't really kicked on, there hasn't really seen much capital growth. Towards the end of a property cycle, it's those areas that have been neglected, forgotten about, and just people have had no interest in investing in, start to do really, really well. Why? Well, it's because it's where the last bit of value is. People will look at areas and go, wait a minute, this area is cheap. Everywhere else is super expensive. And I can still get decent yields here and the property prices are still cheap. And the fundamentals go out the window. Where we talk about, good transport links, good jobs, employment levels. People start to ignore that and go, well, it doesn't matter. This is just cheap. Everywhere else feels expensive right now. I'm going in there. As an example, and I am from this area, it's an incredible place, Liverpool, but North Liverpool in the last cycle was neglected. There were places, streets that were boarded up, whole street areas, been uninvested in. It just was not given attention and the attention it deserved. And that's actually changing for North Liverpool now, which is amazing. But back in the last cycle, before prices kicked on, you could pick up a terrace for 10 to 20 grand. In the space of a few years, they were worth 40, 50, 60 grand. Yes, they weren't going up by 10, 20%. They were in a few short years doubling in value. And that's because they hadn't moved in price, really, through the rest of the cycle. Everywhere else was going up, but these areas hadn't moved. And suddenly people looked and went, wait a minute, this is cheaper. So instead of going from 10 grand and going up 10% to 11 grand, it was going 10 to 20, 20 to 40, and as high as 60. Now, that sounds great, and you might be like, oh, let's go and buy in all those areas now. But this is why it's not for the faint-hearted, because when they crashed, when the lights went out and people went, wait a minute, what's happened? What do I actually own here? The market's in turmoil. Everyone's really scared right now. What do I own? Oh, you've owned in an area with no fundamentals that people don't actually want to buy in. And those properties were hit much harder after the crash. They fell by 40% on average, sometimes more depending on the area. So if you are brave and you truly believe in the cycle, around 2025, you can get in, start buying some of these properties in these areas that aren't as desirable, then flipping and getting out again. Rob, this is an aggressive strategy and we're not recommending it to everyone, but we feel it's an interesting one and it's a very small window you can deploy this strategy. So we wanted to share it.
Yeah, totally. And it's worth sharing because if you can do it, this is the best thing to do in a way. If you're looking to maximize the amount that you can make from property, then of course you want to get the biggest gains and capture those. And you also want to not be there when the crash happens. So if you can manage to get in for the period of highest growth and get out before it all comes crashing down, that's what you should do. The only problem is most people are terrible at doing it. Everyone thinks that they can do it, but whether it's with property or the stock market or anything else, experience and observation tells you that people on average cannot do this. So if you believe that you can and you've got the confidence and the knowledge and everything else, then go for it. But I think I can speak for both of us, Rob, when I say that we do not, and we know what we know, and we know our limits. So we go the other way, which is just to go for a long-term hold. To just keep on buying, keep on holding, watch the rent come in and watch prices go up over the long term. Yes, it's sometimes faster than others, and yes, with some hits along the way. So what do you do with that in 2025, 26? Well, there's a couple of things you can do. It could be appropriate for you to actually sit out the market in this period when you start to detect that things are getting particularly bubbly. Again, I'll point out that people are very bad at knowing when this is happening, but sitting out could be the best thing to do. We've talked before also about selling some of your worst properties at the time when everyone's particularly keen to buy anything for any price. That can be a good thing to do. But if you are going to be buying for a long-term hold late in the cycle, then this is where location and quality in particular become very important. Earlier in the cycle, I was saying it wasn't. Now I'm saying it is. You want to go for quality assets in quality areas. Why is that? Because, as we saw in the last cycle and previous cycles as well, these are the areas where prices will recover quickly and continue to be strong. So in complete contrast to areas like North Liverpool, many of which still haven't got back to where they were at the peak last time round, areas like London rebounded extremely quickly last time. And that's because the fundamentals are there. And because lots of people want to buy, when prices drop a little bit, it tempts people back into the market. So that means that you're going to be taking a smaller hit when prices do fall. And you know that in the cycle to come, they will continue to perform strongly and therefore will be worth, by the end of that cycle, far more than you paid for them towards the end of the previous cycle. Also, Rob, that time when you can see lenders starting to get enthusiastic/greedy again, and you know what's going to be coming at some point in the future, can be a great time to prepare to take advantage of the crash when it does come.
Yes, absolutely. So we will be doing two different things in 2025 and 2026. We will be focusing on really, really high quality assets in high quality areas. A very specific strategy. We're not going to stray away from that. We're going to be very focused during that time period because we know that strategy will be well rewarded in the medium term. But in the short term, you want to take advantage of what comes afterwards. And you've got to be really careful here. People are holding cash now and waiting for a crash to happen are going to really be punished. Because if the market goes up and up and up, you've missed out. You've completely missed out on all that growth opportunity. And your cash in the meantime is being devalued by inflation. But at some point, it will be very useful to have cash on hand to take advantage of the sale that will happen after the crash. So we will make sure we'll be investing in high quality assets and also make sure that we have cash on the side to be able to act quickly once a crash takes hold. Because some areas will fall heavily. We know what the averages are, but that's an average. Some do worse than others. And it's those areas that do worse but still have fundamentals that become interesting. So that takes you into the start of the next cycle. And remember, as Rob's already said, London and other well-regarded areas like Oxford and Cambridge did the best during that period. So if you could be investing in 2025, 2026, and then at the beginning of the next cycle in those type of areas, and not on the fringes and not secondary type stock, but really, really good stuff, then we think you'll do very well. That will be our approach. So this is it, Rob. Like, people have asked for a while now, what should you do? What will we do? And we've laid it out. There's the template. It's really simple in 2022, 23 and 24 what to do. If you believe that the crash will happen in 26, then you start adapting 25, your strategy. But for now, it's really easy. It's just don't miss out. Like, you've waited long enough for this to happen. We've been podcasting for many, many years right now. And there's been times where we've said, you know what, guys, like, no one is interested in property right now and the numbers aren't that exciting, but a boom will come. That's now. And you haven't missed it yet. Far from it. It's only just begun. No, and don't worry, I'm not going to break into the Carpenter's version of that, but it really has only just begun. And you have to be unemotional during this period. Use the data. Look back at what's happened to give you confidence on what potentially could happen in the future. That's all Rob and I have done over the years. All these decisions we've made, all these predictions we've made, are not us getting a crystal ball and making stuff up and putting our finger in the air and going, oh, I feel like it'll do this year. No, it's just looking at history. And not just the most recent history, going back through cycle after cycle after cycle. And we can't take credit for that. Fred Harrison is the one who made the 18-year property cycle, as public as it is and showcased it to the world. And we were interested by it all those years ago. And doing our research and looking back has helped us make predictions that have kind of made us look good over the years. But for me, it's just common sense. Look at patterns, look at data, look at what's happening right now. Look at the fact that lending is still restrained. Look at the fact that sentiment is still relatively subdued when it comes to people's opinions on property, and people don't think this is going to last much longer. Just take all that into consideration and come to your own point of view. You don't have to do what we're doing, but many of you have asked what we're going to do and what our approach is going to be, and now you have it. The template is there. You can decide to follow it or not, but that is exactly what we'll be doing. And we're quite excited because it's an exciting few years of property ahead. There's going to be loads of talking points. There's going to be loads of hype coming. At some point, we're going to have to calm people down, and we'll be saying, hey guys, right, this can't last. But we're not at that point yet. At this point, this is a really exciting time for property investors. So don't be scared by it. Don't be nervous. Enjoy it. As I've said, you've waited long enough for this to happen, and now it's here.
Well, as if that wasn't enough excitement for one episode, we've just got time for Hub Extra before we wrap up. But it's that part of that show where we give you, as the name suggests, a little bit more. And we back this up with a Hub Extra newsletter, which hits your inbox every Friday morning, bright and early, if you're a Property Hub member. And if you're not a Property Hub member, then do sort that out, because it's completely free and you get Hub Extra, you get access to our courses and all manner of other great stuff. So make sure you get signed up at propertyhub.net. Now, today we've shared enough to potentially help you with your investing, but you need to have a bit of downtime as well. So today we're talking TV shows, and for some reason there seems to be a real rush at the moment of TV shows about startups and kind of startup drama. So there's one about Uber, which is not very good. There's another one that, Rob, I know you've been watching, but the one that I've started watching that I'm really enjoying is called We Crashed. And it is, as you might have guessed, about the story of WeWork, the incredible rise and dramatic downfall of Adam Newman. I've only watched the first couple of episodes so far, but it's really, really well done. Jared Leto as Adam Newman is great. He's really, really convincing. And it's just fun. Even if you know the story well, like I do, it's still worth a watch. So you can find that on Apple TV.
Another one you might want to check out is on Disney+. And you may remember, for long-time listeners, that over the last few years, one of the books we've most enjoyed is Bad Blood, which is the story about the rise and fall of Elizabeth Holmes. I won't say too much more in case you've not read the book or not watched this show, because there is a show now that is doing great from a reviews point of view, and I'm about to start watching based on how strong the reviews are, called Dropout. And it is the story of Elizabeth Holmes and her company, Theranos. So if this type of thing does interest you, then check that out, as I'm about to start watching that one very soon. Looks very, very interesting. Bad Blood was a fantastic book, one of our favourites over the last few years. So also check out the book if you've not read it yet. I listened to it on Audible. It was amazing. So check that one out. It's really, really good. What else would be really, really good is if you join us next week. We have a very, very special episode, because next week, some of you listening will own Property Hub alongside us. So it's a bit of a celebration next week, plus loads of good content. So we will join you then. So until that wonderful event takes place, we'll leave you to it. Take care. Have fun. Bye-bye.
Bye-bye.